Imagine the economy as a roller coaster. Sometimes it climbs high, full of energy. Sometimes it dips low, losing momentum. A recession is like one of those dips, a period of economic decline. Economists define a recession as 2 consecutive quarters or 6 months of negative economic growth. This means the production of goods and services shrinks for at least half a year. It's like the roller coaster slowing down and heading downhill. This slowdown impacts many parts of the economy. Businesses might see fewer sales, people might lose jobs or have trouble finding new ones, and it's a challenging time for many. Recessions are a normal part of the economic cycle, like periods of rain in a year. Since the Industrial Revolution, economies have experienced periods of growth followed by periods of contraction. This pattern is natural and expected. The United States, for example, has experienced numerous recessions throughout its history. Some were short and shallow, while others were longer and more severe, like the Great Depression of the 1930s. Each recession has unique causes and consequences. However, understanding the historical patterns of recessions can provide valuable insights into their nature and potential impact. Many factors can contribute to a recession. It's like a perfect storm where several things go wrong at once. One factor could be a sudden economic shock, like a pandemic or a financial crisis. These events can disrupt businesses and shake consumer confidence. Another factor might be high inflation. When prices rise too quickly, people buy less, slowing economic activity. Sometimes recessions are triggered by asset bubbles. These occur when the price of something, like housing or stocks, rises far beyond its real value. When the bubble bursts, it can lead to a recession. Section 4. Riding the waves of recession. Impacts and effects. Recessions impact everyone, though some are hit harder than others. Businesses experience reduced sales and profits, leading to layoffs or even closures. Individuals may face job losses, reduced income, or difficulty finding new employment. The ripple effects of a recession can be felt throughout society. Government revenue declines as people earn and spend less, potentially impacting public services. Consumer confidence takes a hit, leading to decreased spending and investment. However, it's important to remember that recessions are temporary. Economies are cyclical and eventually recover. Understanding the potential impacts can help individuals and businesses prepare for these challenging times. Section 5. Weathering the storm strategies for recession preparedness. While we can't prevent recessions, we can prepare for them, just like we prepare for a hurricane or a snowstorm. The key is to be financially resilient. One strategy is to build an emergency fund. This is a stash of cash that can cover 3 to 6 months of living expenses. Having this safety net can provide peace of mind if you lose your job or face unexpected expenses. Another strategy is to reduce debt. High levels of debt can be burdensome during a recession, especially if your income is reduced. Paying down credit card debt and managing loans can ease financial strain. It's also wise to diversify your income streams. Having multiple sources of income can provide a buffer if one is impacted by a recession. Section 6. The power of resilience. Navigating economic uncertainty. Recessions are challenging, but they also offer opportunities for growth and innovation. Just as a forest fire can clear the way for new growth, a recession can lead to new ideas, businesses, and ways of doing things. During a recession, it's important to focus on what you can control. This includes your spending, saving, and skills development. By being proactive and adaptable, you can navigate economic uncertainty with greater confidence. Remember, recessions are cyclical. They eventually end, and economies recover. By being prepared, staying informed, and maintaining a positive outlook, we can weather the storm and emerge stronger on the other side.